Hi there and welcome to our video on prospect theory and its effect on our trading behavior. Prospect theory by Kahnemann and Tversky from 1979 is one of the core pillars of behavioral finance. It has shown such importance that it was referenced for Kahnemann's Nobel Prize in economics in 2002. What is prospect theory though, and how can it affect traders in an extremely negative way? Prospect theory very well explains the core trading error of a majority of traders. But let's go step by step. Let's first understand what is prospect theory and look at some examples to get a better understanding. Second, deep dive how it affects us as traders. And third, outline what we as traders can do as countermeasures and thereby improve our trading performance. Whether you're trading crypto, Forex, stocks or futures does not matter, as prospect theory is a general behavioral tendency applicable to any trading market. I'm Jonas, co-founder and CEO of Hoc-trade. Let's get started. If you are interested in trading psychology, the different biases underlying our oftentimes destructive trading behavior, and finding ways to improve your trading, feel invited to have a look at our Trading Academy playlist. We have already made videos about other trading biases such as the gambler's fallacy or the blind spot bias, and there are many more to come. So, what does prospect theory exactly say? At its core, prospect theory describes that humans tend to apply an asymmetric assessment of potential losses and gains. Kahnemann and Tversky said that in human decision-making, losses loom larger than gains. Still sounds a little theoretical and hard to grasp, right? Let me walk you through a real experiment that describes the core of prospect theory very well. Imagine the following scenario. You are given two options to choose from. A, 100% chance to lose 3,000 US dollar. B, 80% chance to lose 4,000 US dollar, 20% chance to lose nothing. Which one would you choose? Next, you have to choose between the following. C, 100% chance to win 3,000 US dollar. D, 80% chance to win 4,000 US dollar, 20% chance to win nothing. Again, which one would you choose? Interestingly, when asked to choose between A and B, 92% chose B, so taking the chance to avoid losses. However, when choosing between C and D, only 20% chose D, meaning only a small number of people would take the risk to win more. The experiment nicely shows that humans tend to avoid risks when gains are at stake. However, are much more willing to take risk to prevent losses. We show a loss aversion. Again, this is the core here. People show a strong tendency to not take risks when gains are at stake, but are willing to do so if they could avoid losses. Having understood this, we can apply this to trading as well. Before looking at prospect theory applied to trading in detail, I would like to point out two general things about behavioral biases in trading. First, behavioral biases sometimes appear subjective. They are not a universal science phenomena that can easily be observed, such as gravity. However, there exists a huge amount of research in behavioral economics, up to the point of prospect theory receiving a Nobel Prize in economics. Probably the highest recognition and amount of peer review one can get. In trading, we do not have to reinvent the wheel. We just need to take those known biases, fallacies and behaviors and apply them to trading. Second, working on behavioral biases in trading is not easy. It requires you to look inside yourself, understand your thoughts and processes and derive action items from it. It is not as straightforward as adding another indicator to your trading strategy, but it is the critical point in succeeding as a trader. It is completely normal to have behavioral biases. We all have them, and the earlier we understand and accept them, the quicker we can counteract their negative influence and actually use them to our favor in trading. We already outlined more on the background of working on behavioral biases in trading. You can just check our previous videos on the gambler's fallacy, the blind spot bias, or also the pessimism bias to learn more. Now, back to prospect theory and how it affects us as traders. Knowing from prospect theory that we tend to avoid risks when gains are at stake and seek risks if we could prevent losses, we should have a look at our profit-taking but also our loss-taking behavior. We know that in trading it is about cutting our losses early while letting our profits run in order to have our profits outweigh our losses and be profitable. There are plenty of statements from the best traders in the world outlining this key element of trading. What do we do in loss trades? According to prospect theory, we are willing to take risks to avoid losses. Is this actually a good or bad thing in terms of trading strategy? It is exactly the opposite of what we should do as traders. If we take additional risks to avoid our losses, that means we do not cut our loss early and move on. We rather show a behavior of taking on additional risk in a trade that is already in loss in order to potentially recover our loss and close it in break even or in profit. In terms of trading, that means we may adjust our stop loss even further away in case we're in a loss trade, thereby not accepting our loss but gambling higher in order to prevent the loss. This behavior can actually be witnessed with a large amount of traders and is extremely toxic to our performance as we let our loss trades become big. The Hoc-trade AI tracks this behavior as it's found to have a significant negative influence on the performance of traders. Each trader can see their personal performance effect of this behavior in the dashboard. On the profit side, we can witness a similar toxic behavior. Just instead of letting loss trades become big, we keep our profits small. In prospect theory, we have seen that we rather take the safe, smaller profit instead taking the risk to grow our win even bigger. In terms of trading, profitable positions are oftentimes manually stopped by the trader even before reaching the initially set take profit level. Imagine you're in a trade which went 1,000 US dollar in profit already, with a take profit set at 2,000 US dollar. Many traders tend to manually close the trade at 1,000 US dollar profit, thereby securing their win, but foregoing the chance to reach the 2,000 US dollar profit. Similar to the stop loss adjustment in loss trades, Hoc-trade also tracks the manual stops of traders and simulates the individual performance effect of this behavior on your performance. Doing those two behaviors over and over again, we as traders set ourselves up for failure. It is extremely hard to be profitable overall if we keep our profits small and keep having big losses. However, it is the human tendency to do so, as explained in prospect theory. And we all are humans, so we as traders have to find ways to adjust our behavior, as otherwise we are part of the 85% of traders that are actually losing money in trading. How can we do that? Let's have a look in part 3 what we can do. There might be very individual countermeasures to counteract this typical behavioral tendency, but let's focus on 3 general ones which show to have good effects and have helped many traders, including ourselves. A. Situational awareness. B. Alternate profit metrics. And C. Leverage technology and alerts. Let's get into what those are. A. Situational awareness. If you have watched our previous videos on trading biases, you will be familiar with situational awareness already. It is extremely important, and by watching this video, you're already doing your first step in creating this awareness. Behavioral biases and fallacies are unconscious in nature. Hence, we do not recognize the specific behavior with ourselves, as it feels natural. The first step in working on the impact of those biases in trading is always to recognize your own behavior and be able to make sense of it. The next time you are adjusting your stop loss or manually close your profit trade early, you may first recognize that you now did something likely counterproductive to your performance, and secondly, will hopefully be able to make sense of your own behavior by understanding prospect theory. Adjusting trading behaviors is not an instant process. It always starts with understanding, recognizing, and then step-by-step adjustments. Alternate profit metrics. Much of the trading behaviors we show are closely interlinked with how we value money, and the prospect theory is a very good example for this. Follow-up studies have actually shown a weakened effect of loss aversion with increased wealth. However, this is beyond the content of this video. Kahnemann and Tversky argued in their prospect theory that losses hurt 2 to 2.5 times as much compared to the pleasure equivalent gains give you, which explains much of our actual behavior. In order to soften this effect and thereby also achieve a more rational behavior, as traders we can move away from thinking in currency terms, such as US dollar, but rather think in other metrics such as risks, points, pips. Instead of thinking we lost 2,000 US dollar in a trade, we can equate these 2,000 US dollar as 1 R. If we adjust our stop loss to 3,000 US dollar, we may lose 1.5 R. If we win 4,000 US dollar, we win 2 R, and so on. By doing so, we move away from our value of money, move away from the pain of losing money, and move away from the pleasure of winning money. However, as we learned, the pain is larger for losses compared to the equivalent pleasure from wins. So, eliminating or reducing this pain and pleasure is actually doing us a favor, both emotionally as well as behaviorally. And C, leverage technology and alerts. Nowadays, traders can enjoy a great level of support during their trading by leveraging technology and software targeted at identifying those destructive trading behaviors. Hoc-trade is one of those tools, and as seen in the previous chapter, it measures exactly the kind of behaviors which can be explained with prospect theory. In case the Hoc-trade AI identifies that you would be better off adjusting your behavior, it will send you a near real-time alert in case you have adjusted your stop loss again or just manually closed your profit trade. Prospect theory is not the only behavioral bias with a direct effect on traders. There are many more biases, and tools such as Hoc-trade also cover many more areas of trading. While you can identify those behaviors and also will receive alerts to support you during your trading with technology, it still requires you as the trader to make trading decisions. Therefore, technology can be seen as a great help, which can give you an edge over other traders. But you will still need to understand, recognize, and alternate your behavior in order to utilize the full effect on your trading performance. If you're interested in Hoc-trade, please feel free to welcome our Discord server. We are currently in the closed testing phase and are happy to provide you free access and discuss your experiences. I'll put you the link down in the comments of this video. Behavioral economics, behavioral finance is a fascinating field with incredibly valuable insights for trading. A majority of our oftentimes destructive behaviors can be explained by biases and fallacies, and the prospect theory is truly one of the most important ones. It covers our behavior at the heart of trading strategies, growing large profits while keeping our losses tight. If you're interested in more content on behavioral biases in trading, feel free to subscribe our channel. There has been lots of previous content and there is much more to come. I would like to close this video with 2 quotes. The first one from one of the best traders in the world. The second one from likely the best investor in the world. Both quotes clearly outline how crucial it is to follow what we have discussed in this video. cut your losses early. The first quote from Etsy Kota. 3 elements of good trading are cutting losses, cutting losses, cutting losses. If you can follow those 3 rules, you may have a chance. And on the other side, let your profits run. And here we have the second quote from Warren Buffett. When it's raining gold, reach for a bucket, not a thimble. Thank you for watching. Happy trading and stay safe. Please be aware that we at Hoc-trade are no financial advisor. This video is for entertainment purpose only.